Welcome to the Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, June 13th, 2025. S&P 500 currently sitting at 6,019. I'm David Zarling, and I'm here with our resident Middle East geopolitical pundit, Ian McMillan.
Only.
Any insights there? I mean, that's why people tune in, is they really want to hear about our geopolitical opinions about the Middle East.
Well, I mean, that's how we invest.
Right. Purely based on geopolitical events.
What other events would you invest on?
It's true. But in seriousness, I don't want to, I guess I shouldn't make too lighthearted of a comment.
It's true. Maybe we shouldn't joke.
Yeah.
It'll upset.
But I think it's fair. I know, Ryan Dietrich, a statistician and data guy that we respect, he put out a bunch of information about previous geopolitical events, and man, a lot of them actually have really positive returns 2, 6, 12 months later. Not all of them, but
shocking, I tell you.
Right. It's interesting with the overnight airstrikes on Iran, how price seems to move first or know things before the masses. Because, oil started making a move before the aerospace and defense stocks have been on the move for a few weeks now. So who knew what and when?
Yeah, crude back above 72 bucks a barrel. It was up to 77 at one point. That was probably overnight.
Just goes to show price knows best. And now here we have a situation with U.S. stocks using S&P 500 that we could have a really big overnight shakeout on our hands. We'll see. We got as low as 59.30 overnight on S&P futures.
Really?
Mm-hmm.
Yeah.
Down almost 2% overnight. And here we're currently sitting 0.4% away from yesterday's close. And really, let's not forget that we're only about 2% away from all-time highs in the S&P 500. We're still sustaining trade above a 200-day moving average. I know you shared that with clients via write-up recently, that as long as we're sustaining trade above these important levels, bulls have control. And if we close strong today, even after such an event like last night, still would be indicative of bulls having control.
We're above the 200-day. Late May, went down and kind of tested it. Kind of a mixed bag in this, I'd say like the last 3 weeks, but we continue to move higher. The S&P does. The NASDAQ does. NASDAQ, super close to all-time highs, a little bit off, but on Wednesday, very close. Of course, our friend Russell. Also, it just now made it back to its 200-day on, I believe that was Tuesday, Wednesday. Got rejected the last couple of days. But man, I think that points such a good picture. Russell's just now getting to its 200-day moving average.
Yeah, Russell's still in the doghouse. Still got to its 200-day moving average, and still, you mentioned Qs, NASDAQ, almost all-time highs, S&P 2% away, and IWM for small caps still sitting about 15% away from its all-time highs.
Wow.
But I will say, interesting watching it around its 200-day, but also holding the volume weighted average price from the all-time high back in November of 24. It'd be pretty good information if small caps could hold here and move higher and participate along with everything else. We'll see.
To participate. They aren't. They're just not anything new. There's been very few periods, 5+ years of recording this, that we've been positive on small caps, at least from a relative performance standpoint.
Yeah. I really want that.
Held up well, though.
Yeah, foreign stocks have held up well. And I was just going to say, I kind of really want to buy that Russell 2500 hat.
That would be sweet.
Russell 2000, 2500. We'll throw a party. Once that's back to all-time highs, because we haven't been anywhere for 4 and a half years in that. But to your point about international, still holding up, still pockets of strength.
Yeah, and I kind of figured that if you had told me coming into 2025, foreign's going to have a really good start to the year, I would have leaned into Russell also being an outperformer through we're basically halfway through the year almost, but it hasn't been. Maybe that's a recency bias because trying to go back to like that 03 to 07 period.
Yeah, I was just going to ask you your thoughts on why you had those two linked. Is it because the last time international outperformed was in that 03 to 08 period, and that's when small caps did too?
Yeah, I could probably do a more robust dive into that. But for me, I don't know. I've always kind of defaulted. I know it isn't, it's not an exact thing, but typically you get them to move together.
Yeah, I think that's fair. And I think it has to do with indice makeup too. I mean, international, most of the international indices are financials and industrials. I mean, that's IWM too. That's Russell 2000 too. Financials and industrials are the top two weightings. I don't think that's all that off base. I think if we marry those two concepts, international stocks and small caps, and then you throw in the discussion about the dollar. You did a great job highlighting last week that if we start to get a trend on our hands where the dollar's in a true downtrend, no longer range bound like it has been the past few years, that wouldn't necessarily be helpful for small caps, but it definitely would be for international.
That's true.
And here we sit at 98 on DXY, the trade weighted dollar, still not able to reclaim the prior low. And so it does look like we do have a new downtrend.
Yeah,
on us.
I agree with you. I mean, we broke down out of this range early April, mid-May. We tried to give it the old college go. We're back above 100 for a day, or maybe just early a day. Or back above 101 for a day. And here we sit, new lows this week. 98, you said, lowest on the US dollar index since March 2022. That was on the way up, and we're on the way back down.
Yeah. Well, and from hard markets come easy markets. And so you do wonder if an easier trend, and I'm not saying it has to be an uptrend, but if a new downtrend is upon us, how this all shakes out, and anything priced in dollars, and maybe oil is more about the dollar than it is about Middle East tensions. I have no idea, but anything priced in, because I know we're going to pivot to gold here.
Yeah.
That seems to be setting up pretty well.
I mean, it's had such, it has had a really good run. You've got the relative correction, risk rewards. And if you look at a long-term gold versus S&P, there's definitely some areas in here. 0.05, 0.051. There's some polarity in there. So we'll see.
Yeah, we will. Weak dollar, international holding up. And I know in previous episodes, the past few weeks or months, we're still not seeing, after the tariff tantrums, risk off sectors of the market holding things up. It still remains semiconductors, technology, communication services, financials participating. So we're not sitting in this environment where it's utilities, it's staples.
Yeah.
It's important to pay attention to that information, that it appears that we could look back 12 months from now and the tariff tantrums were just that, tariff tantrums.
When you look at markets, and especially when you think about that graphic, it'll show like 80 years of the stock market, and it'll have basically everything, all these events that have happened, right? Spook events. The percentages say it's likely will trend higher over the intermediate to long term. And every 7, 8, 10 years you get a pretty good one. Have we ever had outside of world wars, these international skirmishes, they ever caused a multi-month bear market in your career?
In my career, so and what I recall is, and I should be clear here that I don't view this as a skirmish. Like 9/11.
9/11, okay.
9/11 happens. We do end up going into a multi-year bear market. But you look at like when the Iraq war started.
And I could say that bear market had already started.
Correct. You could. I think that's absolutely fair to say that we were already starting a bear market when that happens. And then the Iraq war starts in, I believe it's in 2003, March, and that's near a bottom.
Yeah.
You have Syria bombing, the North Korea missile crisis, Russia invades Ukraine. There's so many from the past. You could go back to
like Russia, Ukraine. I mean, the headlines over that.
Mm-hmm.
Very similar to what you are seeing this week today. And it's always, I don't know, maybe it's just that's modern society. Like, that's the news cycle now. But it's, for the most part, I'm not saying that the skirmishes aren't, real and people aren't being affected and lives and being lost. But how quickly we just shrug this stuff off, because it is unfortunately pretty commonplace. I mean, I'd say at least once a year we'll get some. I mean, it's to the point where people constantly joke, oh, World War III started. I mean, it's the term World War III is just thrown around for every single little proxy war, Well,
and like the market does what the market wants to do, regardless of the headline. I mean, it wasn't that long ago that we had an assassination attempt on a U.S. political candidate. Have people forgotten that? And the market's higher since then.
Market's higher. Well, and then you've got to go back to, we're above a 200-day, so you've got to err on the side that these might not lead to big, long, extended drawdowns. Like you mentioned earlier in the podcast, we've already seen this morning. They came right in and scooped it up. Now we've got another 3 hours before the close, but
yeah, and the information that Dietrich put out, he's got geopolitical events that go back to 1940. So everything, including Germany invading France, Pearl Harbor attack, Suez crisis, Cuban Missile Crisis, Kennedy assassination, Iraq's invasion of Kuwait, U.S. terrorist attacks, London subway bombing. I mean, there's a myriad of these, and of all of them, 65% of the time we're higher 12 months out. So you can't take it in a vacuum. You can't assume that Israeli airstrikes in Iran or Russia invading Ukraine immediately means
I shouldn't sell my mid-cap software stocks.
Right. It doesn't. Yeah, it doesn't. You have to pay attention to what the trend is actually doing. Who has control? It's simple as that. Buyers have control or sellers have control. Well, right now, buyers have control. I'm not saying that there couldn't be confusion about that you read all these sensational headlines and think, well, how can the market possibly do this? But this happens all the time. You get a negative GDP print and the market moves higher for the next 6 months. You get a negative earnings report, like just terrible earnings, and that marks the bottom in the stock, because the market's a future discounting mechanism. It's looking out 6 to 18 months in the future. What are the prospects? Well, right now, people are willing to buy equities, both international and domestic, even under these circumstances. That should also be information alert. Like, wait a minute, they're still willing to buy stocks even under these conditions. Well, that's information. How strong could the market possibly be then? I mean, time will tell. We could be down 12 months from now. I don't know.
We could be, right? There's 35% of the time. I was hoping you were going to give like one of Dietrich's 14 for 14 stats. The 65 is still, you have to err on the side that 12 months from now, we're probably higher.
Yeah.
Could be 1% higher, could be 28% higher. I don't know.
And it just goes that you just have to have a plan. We don't need to predict where the market will be, but simply that if we're back below, an election gap or last year's highs or a 200-day moving average that we've highlighted in the past, well, yeah, then you do have to take risk off the table. Then you do have to enter protection mode. It's as simple as that. But it is interesting to note that even prior to these airstrikes, oil was moving higher. Defense stocks have
been strong for
weeks now.
Yeah, weeks. You've talked about Shield.
I mean, even global infrastructure stocks.
Yes.
Higher. So does that point to an expanded war zone? Maybe. I don't want to take some of this lightly. I don't know what Iran, or for that sake, Russia, after the drone attacks a couple of weeks ago. I don't know what they have up their sleeve. I'm not.
Well, and so I'll give you on the back of that, Dave, I'll give you another area that's perked up lately is cybersecurity.
Yeah.
So which, and that tends to be anytime something like this happens. I think there was also a headline about AT&T getting hacked, which is great as an AT&T customer. I'd put it in that same category. All this talk about metals and mining. You've seen those stocks rise. Uranium's been pretty strong.
Yep.
Obviously, silver and gold. So yeah, those themes they've been around.
Yeah, they're nothing new. I think it's appropriate at this time to highlight the supporter of this podcast, the Adaptive Select ETF, listed on the New York Stock Exchange under ticker ADPV, which helps investors access two of the most prevalent factors in markets: momentum and relative strength. Using proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC. And so here, the supporter of our podcast, this ETF, uses risk management. If, let's say that there is a protracted war, what if there's an expansion in war and that does impact the market negatively? You could see an expansion of war and the market continues to move higher. But here you have a potential solution if the market heads into a downtrend that is actually taking risk off the table. And that's really what having a process is about. When we manage assets for clients, it's not about having a prediction. It's just about having a plan. And if we're going to sustain trade above a 200-day moving average, as you highlighted in the write-up for our clients, well, we're going to be involved, regardless of headlines.
Agreed. And I think our clients know that. I mean, if you're a listener to the podcast, obviously clients get the monthly newsletter and years and years and years of the same messaging.
Right.
And I would say that's why clients don't email and call. Well, are we doing anything? Israel bombed Iran last night. Are we doing anything?
Yeah. Not until we've broken below certain levels, and we haven't yet. Could happen. We could be lower 6 to 12 months out and we're not participating in that. But for the time being, the interaction of supply and demand indicates buyers have control of this market and will participate in it. Anything else, any other areas? You brought up mining, gold mining.
Silver versus gold, still a little interesting to me. That relationship had a nice move. I mean, over the last early June into this week, and then sold off at a pretty big level of polarity. So silver, it's the best way to word this. Not the best attempts so far. First attempt to start outperforming its big brother, but rejected real quickly at the 200-day moving average. And I'm just looking at SLV versus GLD. So we'll see if it can. I thought we had maybe something going because we've been hating on silver for a while.
Mm-hmm.
I thought maybe he was trying to prove a point, but might have used up a little bit too much energy for right now. But we'll see. So yeah, still got a lean gold. Well, and then you've got your palladiums.
Yep, palladium, platinum.
I've had really big moves. They've also come back a little. Palladium's down a little bit, and then what do you do on a relative basis? But what's the other one? Platinum is PPLT. Yeah, that's had a pretty good move. Also down 5% today. So we will see. Probably could use a healthy consolidation here.
Agreed. And up against important levels. And we're seeing the energy sector respond positively to what oil's doing. Natural gas had a move prior to that too, but it's still more risk on characteristic. If energy, industrials, tech, semiconductors, international, those are all moving and participating the upside, and breadth remains healthy. You have a NYSE advanced decline line recently making a new high. You have bullish percent in X's near 60. So breadth remains positive, and in some ways, this market still has some things in its hip pocket if it wants to use it. We haven't seen great participation or strength, I should say, out of the Russell 2000. You have weakness out of something like Apple. If Apple stock, which is a huge piece of the S&P, decides it wants to get going, right? Because we've got Microsoft out to new all-time highs. That can't hurt. Apple's been extremely weak. If that decides to participate, that's another tool in the toolbox that could carry the market higher. We'll see.
Agree.
Anything else you want to touch base on? This might be a short one this week, and that's okay.
Yeah, I think where we're at, I think it's healthy. I want stocks to go up just every day, just as much as the next guy. But we continue, and that was the message to clients this month. We're above the 200-day. It's been a healthy multi-week consolidation sideways. And, there's been plenty of opportunities for bears to retake control, but it hasn't happened. And I don't know if that's just there's just not a lot of supply, or there is, but it's, being outdone by all the buying. I have no idea. I continue to like, at least from the S&P and the NASDAQ, Dow a little bit hotter of a mess, and Russell just being Russell. Maybe we should start talking about foreign indices.
Well, we could do it now.
We got to start. The DAX. But what are we going to do? Tell clients markets healthy as long as the DAX is above 23,000. Maybe.
Yeah, the
DAX, that's a possibility.
The DAX is pretty healthy. It's
highly
correlated to U.S. markets. Even the Nikkei is holding up well. It's been range bound for over a year, but it's digesting these levels that it last visited in 1989.
I was gonna say, it could be range bound for the whole life.
Be pretty wild.
Almost. It has. Well, I don't know. And if you look like a monthly chart of the Nikkei, we got some long lower shadows in there, going down to that 30,000, 31,000 area.
Yeah, fair amount of support there.
Yeah.
And so we continue to see that health and strength there, the positive developments in the sectors we mentioned before. And when we have events like we did last night, it pays to pay attention to things like treasuries and the Japanese yen. They're both red today. Those are your risk-off proxies. Those tend to get bought pretty quickly. Gold is up, yes. You typically look at gold, treasuries, and Japanese yen. Well, 2 out of the 3 are actually red today after an event like last night. So again, it's not that last night wasn't real or that it wasn't some type of escalation. It's not like it doesn't have ramifications from an earthly standpoint, but from a market standpoint, right now, we could look back 6 months and this was another buying opportunity overnight. Time will tell. As always,
I like how you said that.
Yeah.
Earthly ramifications. I think that's a good.
Yeah, I'm not sitting here saying I like it. I think you sit most people down one-on-one and say, do you like war? 100% of them would say no. And I think war.
Are we asking Lindsey Graham? Okay, that's as political as we'll get.
Yeah, he's got some conflicts of interest, that's for sure. No one likes war. Now, I'm thankful that when there is war that we have our U.S. military. I'm very thankful for our servicemen and women who defend us, and I wouldn't want to mess with that. I'll put it that way. But no one wants war. No one wants these things. No one wants their kids going off and fighting. And hopefully these things are lessons. Right now I'm watching Band of Brothers with my son Micah, who's 14, and some might say, "Oh, that's a little bit young to be watching that." No, he needs to see. I'm not saying Band of Brothers is end all be all, but there is the greatest generation that won what they won for us. And war is real. It's ugly, and in many cases can be avoided. And I hope these events of the last 24 hours don't escalate further. I do. But as far as markets go, markets are going to do what they're going to do, and we shouldn't sit here in disbelief if they move higher from this point. Sorry, I went off a little diatribe there.
Yeah, very, very well said.
But I appreciate you doing another episode. And I also would be remiss if I didn't highlight that this weekend is Father's Day weekend. Besides giving us a high ranking, make sure you give your dads out there a big squeeze or a message.
Yeah, give your dad a high ranking.
Yeah, give your dad a high ranking. Absolutely. This is my first Father's Day without my own dad. And so my encouragement to everyone out there is make sure you reach out to your pops. Tell them you love them. If you're around them, give them a squeeze, hand them a beer. But just make sure you're showing that love to your dad. I know he'll love it. And thanks, Ian, for being a great dad to your boys.
Yeah, probably the greatest gift I've ever made my wife too. But kids, man, they're amazing. It's a big honor. It's a big privilege to be a dad.
It is, for sure. So thanks for being one, and shout out to all the other dads out there for being great dads. We love you guys.
Yeah, have a great weekend, everyone.